Well, good afternoon. I'm Ken Bibrai, and welcome to Coffee with Ken, a thought leadership series at the nexus of business and politics. Today's topic is using technology to make investing more accessible, and we're joined by Ben Miller, the CEO and founder of Fundrise. Good to see you, Ben.
Hey, Ken.
Well, listen, I think, one of the things that I've kind of picked up on in doing some research on you and Fundrise is really kind of understanding, 12 years ago, 14 years ago, the last financial crisis, lessons learned. Take us back in time. I mean, what was happening in 2008 and 9 that really led you to believe you needed to create Fundrise?
Yeah, it's funny. It's now 14 years ago. So
I know. I was going to say 10, and I was wait.
I get it's still 10 in my mind. Yeah. So, right. So 2008, I was a real estate sponsor in a real estate development company called Western Development. We're doing large scale mixed use development in Washington, D.C. And it's hard to try to explain to people who weren't there. It's sort of like as the pandemic was like a financial disease where everybody got sick and all bankers stopped going to the office because there was no money. There was no money, and all the big institutions who were the money had no money. Like literally, the banks had no money. Like they couldn't lend you properties that are under construction. The banks were like, well, I can't fund the construction. I don't have any money. I mean, it was, and so our big lenders went bankrupt. We had GMAC Commercial, which is General Motors spun off, and they went bankrupt. And I think that was like a $250 billion bankruptcy or something. They serviced a lot of real estate. So I came out of it like pretty cynical. I would say that I struggle with a cynical streak. And so just said, well, is there like another way to do this without all these like institutions in the middle who turn out to be sort of not what they seem to be? And most people lost like probably half their savings in that period, like their house. I mean, I think like 6 million people lost their house.
Yeah,
just outrageously. Outrageous behavior by essentially some of the financial system players. So so the idea was like, can you create like a real tangible investment that's just like, oh, now I own part of this building, or now I own like something that I can understand and see, and it's not like synthetic products that are so big right back then. So that was the big thing. It was just like create something that was a direct to investor, real asset type platform.
So let's talk about the last 14 years. So you start. I think you had to go to the SEC to kind of even get the model validated or approved, right? Talk about that little bit of a journey, right? I mean, you have this idea, but can you even do it? How did you get it? And what are the kind of successive, quick milestones that get us to where we are today?
Yeah. So I think other people have had that idea, like, which is like, hey, why don't you raise money on the internet for real estate, or why can't you invest in real estate through the internet? And the SEC, it's not basically, there weren't any rules around allowing that. And so what I did, which was different than everyone else, I just said, well, let's go to the SEC and find out. And I hired this guy, and I'm in DC, so we went to the SEC. And they're like, oh, that sounds like a really like novel idea. It's kind of interesting. And we figured out how to do it. We spent a year working with them, and they just thought it was like fun and like so different than their normal work. So it was just like purely human experience of how we made it happen. Like there was nothing fancy, just like being able to have conversations with them, and they're like, oh yeah, okay, fine. It just didn't make sense to them. It was so different. I mean, we raised $350,000 from 300 people for $100 a share. And, normal public offering is like $300 million, right? Or whatever. So we basically figured out how to do it, and then we discovered that like nobody was interested. We didn't have any customers, we didn't have any brand, nobody heard of us, and so we had to basically figure out how to do sort of build a customer base. At the same time, we had to figure out how to get real estate deals done, and that's a two-sided marketplace, and so you have to figure out one side. You have more investors. Oh, you have too many investors. Get more deals. Oh, too many deals. Get more investors. Back and forth. And 10 years later, this is something that like you've heard this quote by Bill Gates. He says, "You overestimate what you can accomplish in 1 year. But you underestimate what you can accomplish in 10 years." And so 10 years, like it's the power of compounding. We just kept at it, compounded. So now I think we're raising and investing like $1.5 billion, $2 billion this year. I think we're around the 20th biggest real estate investors in the world. We're growing so rapidly. So and we delivered for our customers now, right? We're really delivering for them. Like the product was designed during a downturn.
Mm-hmm.
And so for a long time, there wasn't a downturn. So people didn't appreciate what was good about it. And that downturn hit, and all of a sudden they're like, "Wait, this is really performing well. I don't understand."
Mm-hmm.
That was the whole idea.
I mean, that's incredible. So break it down a little bit to 2 billion, right? I mean, what type of assets are you investing in? How many people do you have invested? Somebody invests, do you sell? And what are the mechanics of what makes it attractive? I mean, I was comparing the numbers that you posted on looking at the S&P and looking at regular stocks. I mean, you've held pretty solid and better performing assets and returns than pretty much anywhere else.
Yeah, I mean, a bunch of questions. So basically, on the asset side, we've changed over the years. We manage the investments. We have a strong opinion what to invest in, and so we used to do, I think you're a New Yorker at one point. So we used to do emerging neighborhoods in like Brooklyn and LA and DC, and then we changed to emerging geographies in the Sun Belt, and went from like cool infill to like suburban, boring residential. Yep. And so now we have about 20,000 residential units, all sort of Sun Belt, multifamily and single family housing. And we have 325 team members on the team, like 325 people at Fundrise, and 350,000 investors, 1.6 million users. So like we really have scale. And so it's investors invest, they when they buy like a pool or portfolio or a strategy. Like maybe it's like, I really want to buy into multifamily, like apartment buildings.
Industrial.
So something like, or they say, I just want income. I want current income, or I want like high long-term growth. So they tell us what they want. We build a portfolio for them. And then, they can get liquidity every quarter. Like they hit a button and every quarter they get liquid based on the asset value of the portfolio. So it's been really, I think, successful because it's so simple. And and because of a high inflation environment, the kind of real estate we own has been like where you put your money when there's high inflation. Put your money into residential.
So talk about some of these more macro headwinds facing us, right? Inflation, interest rates coming up, coming out of the pandemic, geography shifting. We were chatting before we went live about real estate assets being used differently, right? Like office buildings converted to residential and retail being used as industrial as lab, right? Like things seem to be really, everything's on the table in terms of thinking about how we use our physical space and assets and even invest in them. So I know that's a lot to unpack, but just kind of where do you think we are? Like coming out of the financial crisis, there was no money. You had to come up with a strategy. Today, things are kind of settling up a little bit. Where do you go the next 10 years kind of?
Yeah, it's funny because real estate is a long-term investment, but it actually goes through these like transformations that every 10 or 15 years is a whole new thing. And which is not that long for real estate assets. So if I go back, like way back, right? My father was a real estate developer, and like everybody used to live in cities, and we went and moved to suburbs, and so like for 50 years, all real estate was about building in the suburbs, malls, and like strip centers, and like building these sort of tract communities, and they're just billions, 10, 100 trillion was made of the suburban real estate, and then in 1999, 2000, it shifted and came back to the city. And the city was basically like where all the money was made in real estate, and malls died. And then sometime in the last few years, we said like, no, this trend's going to reverse again. Yeah. And we went and bought tons of housing in the Sun Belt. We said the trend's going to move from these big, expensive cities to less expensive cities like Austin or Tampa. And then what happened was but the pandemic accelerated that trend, right? Except just like accelerated e-commerce adoption. And then the thing that was a sleeper that we didn't see coming, right, was work from home,
Mhm.
like remote work. So like you said it, and just to repeat it, right? So like technology killed the retail business, and all retail is turning into industrial, right?
Mhm.
We used to have, a mall now gets replaced by last mile logistics. Same thing's I think happening with office. Used to have office buildings, and all that value is being shifted to work from home. And so we buying and are super obsessed with like buying the kind of residential in the right geographies. And I think that's a 10, 20-year trend.
Mhm.
Like office, I think office is so dead. It's sad, right? Because I mean, we're going to lose $1 trillion. But like, it's over. I mean, office is like 20 years from now, you'll be talking to somebody who's like, you used to work in an office building? Like, how? What is that? I can't even imagine that. Like, it won't even be a thing.
It's funny, right? Because we do a lot of office leasing on my day job, right? When I'm not having virtual coffees. And we advise clients on how to think about the return to office and space needs, et cetera. And I mean, it's fascinating because we are now dealing with situations where their younger staff members graduated law school, grad school, business school, college 2 years ago, 1 year ago. They've literally never been in office. They've never had to commute. They've never had to badge swipe into a building. They've never had to put their pants on before 8 a.m. I mean, it's like this very strange time that people are just rethinking everything. So, yeah.
Yeah, I mean, I know lots of really big office owners, and they hate when I talk about this, but like Fundrise is 325 people, 300 people, whatever. We were in an office building before the pandemic.
Sure.
We all got forced home. We renovated the office the last year. So, okay, coming back to the office, open the office up, but we said, look, it's optional. We're not going to make anybody go back to the office. 3 people went back. 3 out of 300. Like,
Wow.
I mean, literally, we're like, oh, we spent $750,000 renovating the office for 3 people. And that's when I was like, oh, it's dead. It's dead.
Yeah.
Never. I mean, so.
So what happens? We had a question come in. So what happens in big cities like New York's, DC's, these big office buildings that maybe aren't well suited for repositioning into residential, right? I mean, is this the wave of like a financial crisis, a real estate crisis in cities?
Yeah, I mean, this happened before. I mean, New York City went bankrupt in the 70s. DC went bankrupt in the 90s. It's like, I'm telling you, it's just like these cycles you see over and over again. And so I feel like downtown DC, downtown New York, like Midtown New York, will see massive amounts of foreclosures. People will buy those buildings at pennies on the dollar, and they'll convert them. And they say like, oh, they're not good formats for they're not good formats for for residential.
I actually
It's, they're not good formats for residential, but like the entire rehab of industrial buildings, right? There's this whole movement of like living in cool warehouse spaces that are industrial. Like it doesn't, people will figure out some really cool way to make office work. And as long as the cost, I mean, basically like it's going to have to see a lot of foreclosures and a whole new basis. But once you do, there's just like, I mean, I think New York has 90 million square feet of office that's going to be obsolete, that will be converted. So that's 100,000 new apartment units in Midtown, right, in Manhattan. Like so the city, I mean, arguably at the end of it, like New York will be a better city because Midtown was never that great, right? So you just sort of, you make the city better by bringing more people in, and it just changes the tenor of the pace of the way like the cities work. But it'll be economically, right, for New York and DC and San Francisco and Chicago. Like it's not going to be pretty, right? But I mean, DC 1990s. I grew up in DC, and it went bankrupt, and the city's way better than it was.
Yeah,
way better.
So do you see opportunities in cities, or are you really more focused on? I know you've done some industrial stuff, obviously. So what's getting you excited in the next kind of decade?
Yeah, I mean, unfortunately, I think it's going to take a long time for it to work itself out. We're still in this period, like
always a lagging, right?
Yeah, the 6 stages of grief, right? The first stage of grief is denial,
Yeah.
and then there's like going to be like I don't know after that. I think it's like anger or something. So
Like your banker.
yeah, like suing the banks or something.
Yeah.
I don't know. And so like maybe somewhere in there, there's like I don't know which stage is bailout, but usually there's maybe there's a bailout by the cities to try to figure this out. So it's going to take. I mean, how much are the banks exposed and insurance and pension funds? I mean, isn't it the biggest institutional real estate class? Isn't it?
I think so. Yeah.
Bigger than residential from an institutional point of view. So, I mean, it's $1 trillion.
Yeah. And look, you have a healthy level of skepticism, I think, of just the current financial setup, right, with investment banking and the systems we have set up, right? I mean, isn't this the thesis behind Fundrise to kind of democratize?
I'm a cynic of institutions, and so office is the most institutional of all asset classes. So there will be like office will be reborn just the same way that like retail got reborn, right? Went from a mall to like Main Street, right? And retail changed. So office will change. We actually have a few office investments in LA. They're like old warehouses with the cool buttresses, and we converting them into like big open space, with like we have like 3 Academy Award winning production companies in them and stuff. Like that's the future of office.
I agree. Listen, there's always going to be a flight to quality, things that are not commodity type products, things that are close to where people are. People need to build stuff, make stuff. That's why I'm excited about industrial, right? I'd love to hear your thoughts on, industrial as kind of an asset class at a time where I feel that public policy makers and, elected officials always see success in upzoning these types of assets, which has now reduced the supply of industrial sites because, now they're multifamily or office or retail, but now we have less and we want stuff faster. And now we need to make more stuff at home coming out of the pandemic, and supply chain's a real thing. I mean, what are your thoughts on where that's headed? And you've obviously been invested in a company we had on previously, Saltbox, and, really taking advantage of the maker Etsy economy. I mean, I think they've knocked it out of the park, and great getting to hear from them. And I think you've invested in them as well.
Yeah. So industrial, I mean, I can tell you, consensus view up till now, right, which is that e-commerce, right, converts retail to industrial demand. And like take Washington DC, but it's true in any city. As the cities grew, they would grow into New York, for example. They grow an industrial neighborhood and they convert industrial to residential. So the amount of industrial like declines. The supply of industrial zoning, industrial buildings declines, and actually it's really hard to get more industrial zoning. Like communities don't want industrial in their neighborhood. So it's really hard to convert a mall to industrial, even though you think that in a way it's serving the same purpose. Both were to serve commerce, but one was retail, one is industrial. But it's so there's like a undersupply of it. And there was a lot of like demand. Obviously the pandemic has seen a shift. There was a spike and then sort of a fall again as Amazon sort of started pulling back. But I still think of it as a permanent transition, and it's not, e-commerce not going away. So I think we'll see strong demand, but not as strong as last year.
Interesting. Talk to us about deal flow, right? So how are you raising? How do you balance this out with raising capital and deal sourcing and maintaining the solid equilibrium? How do you do that?
It's challenging. I mean, because the money flows every second. We always have investors, but the deals come when deals are good.
Yeah.
So we have lines of credit. We really stood up portfolio lines of credit. So we have like large lines of credit. So if we see something, we can draw down the line and close on the real estate. That's something like there's a lot of benefits of scale. We got big, and so we can use our leverage to like drive efficiencies. We have a lot of software, and then like better deal making.
Talk to us about the types of investors you're looking for. I mean, people can invest up, starting at $10, right? I mean, how are you thinking about isn't it a pain to have this many investors? Wouldn't it be easier to kind of maybe shrink the funnel and get fewer and larger checks? I mean, that's such a traditional way to go about this, right? I mean,
Yeah. I'd say like I've had big investors and I've had small investors, and the worst is one investor. There's nothing worse than one investor. So like if you ever start a tech company, don't have one venture fund, have like a few. You got a few, and you want them, and ideally they don't really like each other, so they don't collude against you, right?
Yeah.
So like, here's another way of thinking about that, right? Would you rather have 10 customers or 1 million customers?
Yeah.
Right? You'd rather have more customers. It means you have like, it's less risky. You have a diversity of demand. You have a diversity of interests. Like it's the real estate industry. When I started Fundrise, I said, we're going to do this, that we're going to democratize investing. We're going to have anybody can invest. I went to actually this top white shoe law firm. And they were at the top of the Condé Nast building. And I said, like, we're going to democratize real estate investing and anybody can invest. And they said to me, why would you bother with a little guy?
Oh,
like, why bother?
Yeah.
And they just don't understand, like, the institutional world. I like to compare it to like actually every other tech industry. So like, let's take entertainment. So entertainment used to be, there'd be production companies and they'd go and they'd sell to a studio, and the studio would then go meet with Comcast and sell their slate of content to Comcast, and Comcast would distribute it, right? But what happened? Netflix basically said, I'll go direct to the customer.
Yeah.
Right. So it used to be, entertainment business actually used to be a B2B business, and Netflix made it a B2C business. So like real estate used to be a B2B business, and we're making it a B2C business. So it's the same thing. Amazon did the same thing. Tesla did the same thing, right? Like car companies like used to, like, they don't sell direct, they sell through dealers. Yep. Like it's so many industries are B2B businesses, and the internet basically like drives you to B2C. Like it disintermediates all the status quo players. So it seems counterintuitive to real estate people, but it's just how every other, I think how the technology drives change in any sector.
When you think about the investors, I mean, every level, right? You have sophisticated investors. Is it for entry level investors? Does it matter? I mean, what's your pitch to the people listening who are like, maybe I should put in $100, $100,000, whatever?
Yeah, we have, investors with 8 figures on the platform, investors with $10 on the platform. I think of it as like, everybody has an iPhone. You can be Jamie Dimon and you can be a construction worker. Both got iPhones. Like it's the better product wins. That's what technology does. It actually democratizes access. From my software point of view, like Jamie Dimon's investment and your investment are both just bits in a database. It doesn't matter to us. Like, and if I'm a big investor, I think you're better off actually, because it seems like, your white glove treatment is better, but actually, it's not. All that's BS. And all that matters is using technology to drive costs down. Like so, the more salespeople they bring on the call to convince you to invest or invest, or like the more skeptical you should be that the investment's very good.
Oh, that's funny. Well, look, you just raised a bunch and created a VC arm, right? So talk about the evolution. Where's Fundrise going? It's been traditionally real estate. Tell us about a new VC and what people can expect coming down the pike.
Yeah, so we created the infrastructure. We democratized investing into real estate, which previously people could invest in stocks, they could invest in bonds, but they couldn't invest in buildings. So we made it as easy as like buying a book on Amazon, and we did that for 10 years, and we're scaling. And we have a lot of interesting things going on in that part of our business. But that infrastructure is applicable to other alternatives, like other things. Most people can't invest in pre-IPO companies. And like, Snowflake or all these companies, take Uber or Facebook. They were a great investment in when they were Series A, and they were a terrible investment when they went public.
Yeah.
Right. I mean, they're basically post-public. Uber has done terribly. Like the private companies staying private longer, and individuals can't get access to them.
Sure.
So we're gonna try to break that industry in the same way we broke down the real estate industry. And it's been interesting because a lot of our investors are like, how are you going to do that? Like, I'm worried you're going to get distracted. We have a very skeptical investor base. It's not like a crypto. We're like Wall Street bets are like optimists. Yeah. Our investors are like skeptical. They're just, anytime we tell them anything, they're like, prove it to me.
Fascinating. Doesn't come
Yeah.
from leadership, right?
Obviously, yeah, exactly. Maybe we just attracted our own type. So, yeah. So I'm skeptical of these venture investors. I've had a lot of venture experience because I've been both sides of the table. I've raised money. I've been doing my first job out of college. I worked for a tech startup from 99 to 01. So I know, and then it blew up. So I've seen venture go through lots of cycles, and it's like it's a little bit Wizard of Ozzy, like the venture guy behind the curtain, like it's just like three guys and a dog, right? It's not like Google has incredible technology.
Yeah.
Venture people, it's just three guys and a dog and a spreadsheet. I mean, there's not like a lot of like they're there, even though they're smart. I mean, they're smart people. Don't get me wrong.
Yeah, of course. Interesting. Talk real quick about patience. I mean, how do you maintain a level of patience, and do you feel pressure to pull the trigger either on making an investment or moving forward with like leasing something if you have a big industrial? Like, how patient can you be? How do you kind of keep your investors happy and kind of hold the line with all the kind of competing pressures with a lot going on?
Yeah, individual investors are so much better than institutional investors because individual investors, it's their own money.
Yeah.
And so if our investor's 30 years old, like this is a long-term money.
Yeah.
We don't take a 20% promote like in normal venture or real estate. The fund or the real estate takes a 20% carried interest, like they get 20% of the upside. Fundrise doesn't take that. So we don't have the same incentives to take risk. Like and our investor like would much prefer like if you could achieve a riskless 10% return that just produced 10% forever versus a 20, then a -5, then a 7, then -2. They hate that. So we're really focused on like I say we're the tortoise, not the hare. It's like just do the right thing. And in the tech industry, last decade, tortoises were punished. Like we were a tortoise, and the tech industry was like, no, hare, go fast. And I was more, fast, spend. And it's just like, that is not what we are. It's not what we're about. And so, like, again, people didn't appreciate it until the shit hit the fan. Oh, sorry. Till the the cows came home, whatever the rooster, whatever the saying is. And so now like you can see that in the long term the tortoise always wins. I mean it's a aphorism for a reason.
Yeah, well, it's funny because and then we'll wrap it up. But I was listening to a talk you did with Warden last September, and I think you made the point of saying, what's going to be important to watch if the economy goes down and interest rates come up is what's going to happen with crypto and if it stays up here. What are your thoughts now in a minute on just crypto and this landscape and what's going to happen?
I think crypto is like internet 1999. I think it's going to go into like it's going to go into dust. People will look at it at some point, like 2 years from now, and be like, "I'm leave it for dead."
Yeah.
And then out of the ashes will come some great innovation, but it's gonna have to go through sort of the full Phoenix life cycle before I think it really like starts to get like normal people who aren't tech heads adopt it.
Got it. Ben Miller, ton of fun. I will not ask to go meet you at your office, but look forward to getting a real cup of coffee in DC one of these days. Congratulations on all this amazing success. Appreciate you taking the time to come on today. Everybody tuning in, thanks for being here. We're going to take a little bit of a break for a couple of weeks. Next conversation will be September 8th with Pam Liebman, the CEO and president of Corcoran Residential. In the meantime, be sure to visit coffeewithken.com. You can check out past episodes and subscribe for future ones. In the meantime, have a great summer. Ben, good to see you.
Thanks, Ken.
Thanks, man. Bye.